Markets are closed right now. No bids, no asks, no price discovery, and the most volatile precious metals week since the 2020 COVID crash is sitting completely unresolved. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Gold at $4,704, silver at $71.35, both in documented high volatility regimes. The macro that broke them this week has not changed by 1 basis point. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. Weekend gap risk. Gold fell 6.6% in a single session this week per Seeking Alpha. Silver plunged more than 13% before trimming losses. Those are not end-of-week numbers. Those are single-session numbers. The gold-to-silver ratio hit 66.88 intraday on Friday, a day range of 63.22 to 66.88. That is a 3.66-point swing in one session. A ratio moving 3.66 points in one day is not volatility. That is a market and structural repricing. And every single input that drove those moves is still live right now. Oil still above $100. Fed plot still projecting one cut. Iran still at war. The timing is what deserves scrutiny, not the moves themselves. The timing. Every one of those catalysts remains active with zero liquidity to absorb them until Monday. Think about what that sequence actually means. The ones paying attention already know what to watch next. Before I show you the full gap risk picture, consider this. The last time precious metals posted weekly losses of this scale while sitting in an unresolved geopolitical conflict, the Monday open gapped between 3 and 6% in a single direction. The data is already telling you something. Let's build it out. Now let's build the full picture because this weekend gap risk does not exist in a vacuum. The Federal Reserve March 19th plot is confirmed. 1 projected rate cut for 2026. 7 of 19 FOMC members project 0 cuts per the Federal Reserve's official release. Fed Chair Powell said directly at the press conference, and this is a direct quote from DataTrack Research, "I wouldn't say there is a conviction that this is going through quickly or not quickly. You have to write something down." That is a Fed chair openly admitting uncertainty about the policy path. That admission sits unresolved all weekend. EY Parthenon chief economist Gregory Dacko went further per Grokopedia. It is entirely plausible that the Fed won't deliver any rate cuts this year. Rate hike bets, which were 0 3 weeks ago, are now real and priced in futures markets. At the same time, the Bureau of Labor Statistics confirmed the U.S. economy lost 92,000 jobs in February, unemployment at 4.4%. Rich Dad Retirement cited one senior economist calling this one of the toughest moments in recent memory for the FOMC. Rising inflation, falling employment, no liquidity until Monday. The rate of uncertainty is not slowing, it is compounding. The data is doing the talking. The ones who said this Fed environment would eventually crack precious metals paper positioning, they are not being argued with much right now. And here is what makes this weekend picture even harder to ignore. Shanghai silver is paying approximately $8 per ounce above COMEX right now per Trading Economics. That physical paper divergence is a second independent layer of gap risk. If any weekend development forces paper prices toward physical reality, the gap on Monday open could be violent to the upside. At the same time, COMEX paper positioning is in aggressive liquidation mode. Physical buyers in Shanghai are paying $8 more for real metal. Paper sellers in New York are driving the benchmark price lower. Those two markets cannot both be right about value simultaneously. That is not a contradiction, that is the setup. And before anyone takes that physical premium as a green light, setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Now the Iran war, because this is no longer background noise, it is the primary variable this weekend. Here is the number most people are not running. 92 cents. That is how much the U.S. national gasoline average rose in a single month per AATA data, confirmed by DataTrack Research. Brent crude sits above $107. The U.S. and Israel are 3 weeks into active military operations against Iran. CBS News reported, and this report directly moved gold lower in Friday's session, that the U.S. is preparing to potentially deploy ground forces into Iran. Markets are still pricing this as a contained regional conflict. Look at $107 Brent and an active ground force deployment discussion and tell me what probability you assign to that containment assumption. When markets are forced to price the reality of what an expanded Iran ground engagement actually means, gold reprices up, silver reprices up, the dollar reprices as a safe haven flow. That is the historical pattern. Every time a regional conflict expanded beyond its initial scope, it has not been different yet. Gold Western spot at $4,704, silver Western spot at $71.35. Shanghai silver physical price approximately $8 per ounce above COMEX per trading economics. Bullish gap scenario for Monday. Iran ceasefire signal. Oil drops $10 to $15 per barrel on a weekend statement, or a Fed official comment suggesting the rate hold is nearing its end. Any single one of those events gaps gold $150 to $300 higher and silver $5 to $8 higher at Monday's open. Bearish gap scenario for Monday. A CBS confirmed report of U.S. ground forces deploying into Iran, further oil infrastructure strikes, unexpected Fed hawk communication, or a large institutional fund announcing precious metals liquidation. Any single one of those gaps gold $150 to $200 lower and silver $4 to $6 lower before Friday's lows hold. That is the only short-term read that matters right now. As for positioning into Monday, I cannot see a clean picture on the lower time frames right now. I cannot tell you what gold does at the open. I cannot tell you what silver does at the open. Nobody can. If you think you know, good for you. The next Fed policy checkpoint is April 28 to 29, the next scheduled FOMC meeting. That is the next structured opportunity for the rate trajectory to be formally revised. Until then, the macro remains binary. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this weekend trade have a real case, and the one you ignore is the one that costs you. So let's run both clean. The bear case is real. 1. Fed rate hike bets have moved from 0 to real in 3 weeks per futures market pricing. 2. DXY at 99.42 is technically targeting 103 to 105 resistance, creating mechanical headwind for dollar-denominated metals. 3. Gold lost 6.6% in one session this week. A move of that velocity leaves leveraged long positions technically fragile into any Monday extension lower. The bull case is equally real. 1. Shanghai silver is paying $8 per ounce above COMEX per trading economics, confirming real physical demand has not reversed with the paper price. 2. Powell admitted directly the policy path is uncertain. Any weekend de-escalation signal reprices June cut odds instantly from their current 16%. 3. Central bank buying programs that drove gold's 64% run in 2025 show zero reversal in published reserve data, providing a structural floor that paper liquidation cannot permanently override. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. The gap has not happened yet, but the conditions for a significant Monday open are fully assembled. Closed markets, unresolved macro, active geopolitical binary, and physical paper divergence running $8 apart. All four simultaneously. Do not take my word for it. Verify every number I gave you today. Check the data yourself. Federal Reserve at federalreserve.gov. Gold and silver spot pricing at investing.com. COMEX futures and positioning at semagroup.com. Logic over hype, always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0. Out.